Thank you, Eley. Welcome, everyone. Welcome, panellists. Good to have you all here. Now, we've got the 3:15 time slot. Everyone will be falling asleep, so I want you up and energetic. We've got to fill in 45 minutes, and I know you can all talk underwater, so I'm not too worried. Now, just a little bit of explanation before we kick off is the good, the bad, the ugly. The good is something, obviously, that the panellists like, what's going on in the world, and then we'll get to some good stock picks. They've all come along with a stock pick. The bad is something you can avoid at the moment. Not too horrible, but a bit bad at the moment. Maybe just take a wide berth at the moment. But importantly, the ugly is something, if you could short, you would short it, and you feel really strongly about why it shouldn't be working at the moment. So that's how we're going to structure it. And the other thing is, in the movie, The Good, the Bad, the Ugly, the 1966 movie, because we're going to start with the good was Clint Eastwood. So your chance now to be Clint Eastwood for about 10 minutes, gentlemen. So we'll get into that. We'll start with each panellist talking about more of a thematic or a general concept that's good at the moment. And all four panellists have very different strategies that they take to the equity market, which is interesting. One equity market, different strategy. So we're going to get different answers from all of them. Dushko, I'll start with you. You obviously are a growth manager and you concentrate on Australian mid-caps. The Australian market, much maligned for being underweight growth and tech compared to the American market, but you've got a bit of a contrary view that maybe there are some good growth stories out there.
Yes, absolutely, Matt. Thanks for the opportunity to showcase this idea. I think, in actual fact, we have a lot of good enterprise software companies in Australia. And I think, unfortunately, they live...
And sorry, Dushko, you're not allowed to give us your best pick yet.
Yeah, no.
Say other companies, that'll come in a minute.
I'm building up to it. So we've got a strong cohort of enterprise software companies. Unfortunately, when I look at the financial press, a lot of inches in the columns are devoted to how expensive they are and how poor an investment they're likely to be in the future. And very little is communicated about what they're doing, why they are successful, why they've been successful in the past, and why they might well continue to be very successful in the future. And so, you know, they get to sort of live the life of, and I hear AI and NVIDIA has been incessantly mentioned in today's session, so I'll throw it in just to keep consistency. They kind of lead the press life of NVIDIA and Jensen, the CEO there, but without any of the reverence, because we're here in Australia and we love to cut down our tall poppies. So there's no reverence or positivity in talking about these high quality, global leading Australian enterprise software companies, which is unfortunate because I tend to, when I see the comments, I can see that the analysis stops at the PE ratio. And because people stop at the PE ratio, there isn't a whole lot of work or follow through thereafter, which really is disguising a great pool of investment opportunities. I'll now mention the stock.
You can mention some others.
So before I mention the leading stock of this group, I would include Pro Medicus, which creates software for radiologists to view the images and make diagnoses. Medical scans. I would also highlight Xero, which I'm sure many in the audience will be well acquainted with as users in terms of cloud-based SME accounting software. We can also mention the dearly departed Altium, which was the subject of a really knockout bid by a Japanese firm, as another example of a leading Australian enterprise software company. And there are some up-and-coming ones. The audience will be well acquainted with Hub24, but also SiteMinder, is another one that's doing extremely well. Now, in stopping with the analysis because you're balking at the high multiple, what you're missing is collectively, why is it that we have a pretty strong cohort and we punch above our weight? And I think as much as a comparative advantage to Australia is our iron ore industry, we're extremely low costs, we've got a small population, we can export it and make money all the way through the cycle, even when ore prices are low. It's a gift to Australia. It's a natural competitive advantage. I also think we have a natural competitive advantage when it comes to enterprise software. And what does software do? It solves problems. And so what is the most burning problem to be solved in Australia? And it's all about efficiency. How to grow efficiently, because we live in a very high labour cost economy. We can't just add on more units of labour. And so businesses that have written software to make their clients more efficient in their business enterprises are really doing particularly well. We're very highly educated. We've got a great skill base in terms of software engineers. And so I actually do think it's a natural competitive advantage for us to be developing this software, or to have entrepreneurs such as Pro Medicus who've harnessed this skill set and created a lot of productivity gains in, for example, the radiology business for Pro Medicus. But I think the leading light here is Wisetech. That's the company I'm here to talk about as a leading exponent of this. And whilst Richard White can wear a leather jacket almost as well as Jensen from NVIDIA, like I said, there's more negative column inches devoted to Wisetech because of the valuation. And unfortunately, what a 1 year PE does is it stops at 1 year. It doesn't ignore.
It's up 80%, I think, this year.
It is indeed. And it shouldn't be something that's overly confronting. You still sort of need to do the numbers and analyse what's going on here. And since it listed in April 2016, it's grown its top line by over 30% per annum compound. Its EPS was 8.5 cents in April of 2016. It's now $1.30. That's a 15 times increase in its earnings per share. And its share price has gone along with that. The wonderful thing about Wisetech is how much of its growth is within its own control. When you disaggregate that 33% top line CAGR over the best part of a decade, about 12% of it comes from the continuous rollout of large global freight forwarders, the top 25, so to speak, that they've got 3, 4, 5 or 6 in train at any particular point in time. That's about 12 percentage points of the 30% of top line growth. About 10% comes from new product extensions within the existing base product that you charge a higher fee for. Another 5% comes from brand new large initiatives in terms of new products. About 5% comes from existing clients doing more business with you as they themselves are gaining market share. And this is the wonderful thing about the product. It enables freight forwarders to gain market share against their competitors. And about 5 percentage points comes from acquisitions, and only 1 percentage point comes from market growth. So I sort of read quite often that trade volumes are up or down and the share price of Wisetech reacts, and really it's 1 percentage point out of 33 percentage points.
So that PE is a killer.
Yes.
Pro Medicus, which is one of the other ones that you mentioned, it got to $4 on its current run. PE was 27. That was enough for me. It hit $160 the other day.
Yeah. So I will address valuation, Matt. And when you look at the life of Wisetech as a listed company, it has ranged in PE from 40 at its lows. It's never been below 40 times forward PE, and up to 130. And in fact, it's averaged 75 times PE next 12 months over that sort of 9-year listed life that it's had. But when you can 15x your earnings per share over an 8-year period, and you've got prospects to continue to do that for the decade ahead, that's essentially what you're paying for. And that PE comes down pretty quickly when you're generating that amount of cash flow and earnings.
All right, I'm going to hold you there. Thanks for that. I'm going to go to the other extreme now. James, value investor, 10 stocks in the portfolio. At the moment, the thematic resources, been a hard year for resources, but you think there might be value emerging there and reasonable PEs.
Yeah, we do see, thanks Matt, some value in the resources sector, and I think there's a real opportunity to make some money as there's a rotation out of financials, and financials is where we see there to be some real valuation extremes at the moment. When people ask us why is that, we say, well, there's a couple of reasons. The first is that globally financials have run, and so when investors look at, offshore investors look at the Asia Pacific region and they want to invest in banks, they look to Australia. They don't want to invest in, China banks. So you've got that financial thematic that has run globally, and when that shifts, it'll shift in every geography. You saw a few nights ago when, Goldman and JP Morgan's results came in unders. Well, then, the Australian banks were off, and they haven't turned off yet. But that will turn at a certain time in my view. The other reason is the significant flow of funds into passive. So when CBA 15 months ago or so ago was circa $90 when there was the US regional banking crisis, it made up 8% of the ASX 200. It now makes up 10% of the ASX 200. So it becomes self-fulfilling in terms of the more passive flows that flow into the market. They used to give 8% of their money into the CBA stock, now they give 10%. So what you have is some valuation extremes across the banks, and in particular CBA, whereby CBA's double the valuation of JP Morgan. For a value investor, that doesn't make sense when you have a dividend yield which is less than the cash rate here in Australia with no EPS growth. So we see the value in the resources sector. That's not a easily welcome sort of thought at the moment, but we are contrarian, we are value. That's where we see the value. We see the value having regard to the macro backdrop, and that's where we see some real opportunities at the moment, Matt.
All right, give us a stock that's good. There's a chart behind you. I think it says BlueScope.
Correct.
That's a prompt. Tell us about BlueScope.
So BlueScope is an Australian steel producer that also has operations in the US, and it's becoming more and more a US company over time, where 60% of its earnings are going to come from, going forward. Why do we like it? It's cheap. It's a mid-teens PE. It's growing its production through its North Star facility in the US. It's going to be on a nearly double digits free cash flow yield a couple of years out. Critically, it's a very well-run company. The management team that is led by Mark Vasella, we've known for 2 decades. Mark runs a very top-class management team, and one of the privileges of our job is that we get to compare and contrast the boards and the management teams across companies and across sectors. And when we meet Mark and his CFO and his management team, we put them in the top echelon of management teams. So we think as they grow their production through their North Star facility, the market will start to recognise that there's a lot of production volume growth in this company. The steel spreads in the US and Asia are at quite historic lows, which again we think from a contrarian investor's perspective is a good time to buy. And importantly, there's been a backdrop of M&A activity, as evidenced by the Nippon Steel bid for US Steel. That is getting a lot of political opposition from Kamala Harris and the Democratic Party and Trump in the US. But at the end of the day, it evidences the strategic value of these steel businesses in the US.
Very good, thank you. Now we're going to shift gears again and go to the small to mid cap area. We've got, I think you would introduce as veteran, Ben.
I was.
So you've got a long history in this area of the world. Let's start with the thematic. What are you seeing that makes you feel good about what's happening in your portfolio in that small to mid caps?
Thanks, Matthew. I think through the lens of a small and mid cap manager as we are, it's pretty hard to dispute or be unhappy with the cost management performance that we've seen on show from Australian corporates, especially down at that small and mid cap end of the market. The most recent reporting season highlighted some outstanding cost management trends, and that followed up from the February results season where we saw again brilliant cost management was on display. And that's important because from my observation, cost management wasn't much of a skill that Australian corporates excelled at. It was really the domain of US corporates who would deliver their results, and you'd be amazed at how they were able to wind costs out long before revenue fell over. So it was the skills of the American company managers that I used to admire. We're now seeing it displayed locally. Just locally, I mean, we've seen Iris, who reported a great result and made a big point that they're wringing costs out of their business, and you saw the results, they were tremendous. Reliance Worldwide, who of course have got a plumbing operation here and or plumbing product business here and in the US, were boasting about how they've been able to remove cost. And we saw the same thing with JB Hi-Fi, who JB Hi-Fi are continually sailing into an environment of higher input costs, but all the while they're able to drive cost out of their business and deliver great margin growth. And when I talk about cost, I'm talking about everything from labour shedding, site consolidation, optimisation, debottlenecking of plants, smarter and more astute procuring of products and services, and we're seeing that displayed en masse across the Australian market, especially in our small end of the market. I really was quite heartened when I had a look at Jefferies' estimates for FY25, that is the financial period we're about to sail into, and they've assumed in aggregate across the ASX 200 that will see revenues contract about 3% this year, but will have EBIT margins holding constant. suggesting very clearly that top lines are under pressure. And I think we all know that it's getting harder to sell a product or a service these days. But margins are holding constant, which tells me that there's good cost management predicted. And that's very heartening.
Well, let's go to your stock. Run, ironically, from what you said, by an American big Jim.
Correct.
And it's Breville.
It is Breville. There it is there on the screen.
Yep, give us a bit on Breville.
And Breville, of course,
Look it up.
Almost everyone in the room knows Breville, food thinking since 1932. And Matthew's right, run by a large, feisty American. And it's also been a very, very astute cost manager. That's part of Jim's signature, is his cost management. But what's been going on below surface, of course, quietly, Breville have been investing heavily in product development, and product development's always been an area of specialty. Breville have been investing heavily in product development, and we're now going to see, coming out the other side, the results of that investment in new product releases and launches. The recent result was tremendous, and the main focus of Breville, of course, is their growth through the United States and their growth through Europe, where they're growing market share. With the new products, they'll enter new markets. With new products, they'll grow existing market share. We think grow earnings. In terms of pricing, Breville's not as cheap as it was. Back in early 22, Breville was a 20-time stock. Today, Breville is back to where its 5-year average is, around 31 times, talking about fulsome PEs. But Breville's trading range has been between 20 times and 45 times.
Is that enough
through the cycle?
Is that PE high enough for the growth? Yeah, there we go.
There we go. So we're getting endorsement for the panel. So Breville is my call for the next 12 months, Matthew, for all of those reasons. But I'm most comforted by the fact that I know Jim will take cost out if he needs to take cost out.
All right, thanks, Ben. Okay, let's go global, Dave. Get on the plane, go around the world. A lot of different themes going around the world. We've heard a lot about AI, but one that I know that we've looked at in the small cap portfolio in Australia is defence spending globally, and that's something you think there's an opportunity in, and it's a good place to invest at the moment.
Yeah, 100%. I think the defence spending is probably the mega trend of the next 5 or 10 years. And it all began, of course, with the Ukraine invasion. It woke the Europeans out of their slumber. It woke many countries out of their slumber and said, right, we can't just rely on the Americans or someone else to do the heavy lifting for us. So if you look at the raw numbers, global defence spending has reached $3.5 trillion now. The last year-on-year increase was the biggest since the GFC, which was really just a rebound. So countries around the world, especially you've got the Middle East crisis, you've got tensions between China and Taiwan. So there's multiple hotspots, and the great thing about this is these companies are doing very, very well. The likes of Lockheed Martin, BAE Systems, Rolls-Royce is up a couple 100% since we bought it. So there's great growth opportunities, but if you look at the risk of these names, they're very defensive in nature. Like when tensions go through the roof and the drumbeat of war becomes louder, these companies actually do very, very well. They're low beta names, so they're
defense is defensive, huh?
Defense is defensive. That's right. That's what you're looking for. You're looking for high opportunity, high alpha names that are actually quite defensive. So they play a good ballast role in the portfolio.
So we're going to have a look at your stock, which is not about defence.
It's not.
But it's another global stock. We've let you off and allowed you to go a bit broader.
Yep.
Vertex Pharmaceuticals. You wowed us last year, I think, with shocking predictions where you killed obesity. You said it was gone.
Yep.
So this is in the same vein in the sense it's pharmaceutical.
Yes.
US listed.
Yeah, definitely. So we spoke about the GLP-1 drugs last year that have been an absolute phenomenon. They're projected to be $100 billion revenue a year market by 2030. So they'll be the best-selling drugs of all time. As an aside, my tennis buddy, he wasn't even a big boy. He's about 100 kilos, and I was beating him game after game, and he went on Ozempic, and he went on it for health reasons. All of his bloods, his blood pressure, his liver function, his blood sugar, blood pressure, all were way outside the normal range. Within 3 months, they're all perfectly in line, and he's beating me in straight sets. So it's I'm very unhappy about it personally. That's going to be a phenomenal drug. And they always said obesity, it couldn't be cracked. It was an R&D graveyard, right? Another another disease that was an R&D graveyard was cystic fibrosis and the treatment of acute pain. And Vertex Pharma have actually, they've certainly cracked cystic fibrosis to a very large extent. For any of you who don't know what it is, it comes on in early childhood, affects the lungs. Life expectancy as recently as 2005 was just 29. You know, it's a horrific disease. And with the medicines from Vertex, the life expectancy already is extending well into your 60s. I met with a client the other day who knew that I was invested in Vertex, and they said, "Oh, my daughter's on Trikafta, which is the medicine." And I said, "Oh, you know, how's it been going?" And he said, "Well, she couldn't walk more than 50 meters without having to sit down and catch her breath. Now she plays netball 3 times a week." So it is life-changing, some of these medicines. I mentioned the other really exciting growth pipeline for Vertex Pharma, which is an insanely profitable company already. But in their R&D pipeline, they're attempting to crack the treatment of chronic pain. And you know, if you've seen any of the series on Netflix and Binge and that sort of thing, you'll know the havoc and destruction that opioid epidemic has wrought across communities and individuals. In America, for every 100 Americans, there's 40 opioid prescriptions still written to this day. It's a massive number, not because doctors don't realise how dangerous they are, but because there's no alternative. So Vertex have developed a drug. It just passed their phase 3 trials with flying colours, okay, and will be on sale next year is the expectation. And it rather than dealing with pain at the central nervous system level like an opioid does, it attacks it at the peripheral nerve endings, and has been shown in trials to be almost as effective as opioids, but entirely non-addictive, non-habit forming.
Well, let's hope this one does live up to that, because there's been a few others that have
absolutely. That's it's been a real and just with the anti-obesogenic drugs, you know, there's failure after failure until someone cracks it. So
yep, definitely. So, gentlemen, we've spent the first half on the good. That's fine. Markets go up. We've got to get through the bad and the ugly in the other half. So we're going to have to tighten it up a little bit. We'll see how we go. We don't have to cover every corner. But the bad, as I said, something you might want to avoid at the moment. Lee Van Cleef played the bad, not as big as Clint Eastwood, but you do your best, Lee Van Cleef. And Dushko, bad for you is growth companies that aren't really growth companies that mightn't grow their earnings?
Yeah, look, when I think about bad, I think they should be so much better. So they're really disappointing. And, you know, I'm going to highlight a couple of companies here that we all know very well. And the theme is stick to your knitting, stick to what you're good at. And when it comes to your hobbies, keep them on the weekend. Don't bring them into the boardroom or any of your acquisitions. And I'll start with Woolies. You know, Woolies ideally should just be Australia's best supermarket, and preferably nothing else. When you look at Big W over the last decade, it's been profitable only a couple of years out of the last decade. And in its most recent set of results, it earned a $14 million EBIT of $4 billion of sales. You know, it's pretty obvious that what Woolworths is doing, hopefully the new management, I'm not sure about the former management. I think the former management had some belief in being able to revive that business, which I don't think can be, especially with the performance of Kmart. Hopefully the new management is really just running down the leases. So 10 years ago, it had an average lease expiry of 12 years. It's down to 6 years, and hopefully within 6 years, we'll see the end of that business within the Woolworths portfolio. That's just destroyed capital and distracted management. On top of that, they've also had New Zealand supermarkets, which has gone from a peak EBIT margin of 5% down to below 1% and is requiring a whole heap of investment. Again, it was a bit of ego and arrogance from Australians who think they can do better. They got cleaned up by Pack and Save in New Zealand, who are probably one of the most aggressive and successful retail operations in the world, and they've just lost a lot of money there. I haven't even mentioned Masters, where they dusted a couple of $1 billion when that ego projection happened as well. So the advice of the new CEO who came into the office and wanted to see what we might be interested in as an investor going forward was clearly given a direction from us that we'd just love you to be a simple Australian supermarket that's extremely efficient and reinvests back into your business and your prices, and makes the most of your superior supermarket locations, which won't be able to be matched by any competitor. Finally, CSL has been an amazing company that traditionally has done fantastic acquisitions. Aventus Bearing, bought in 20 years ago in 2004. Plasma fractionation, which is the middle of the fairway for CSL. That's its business. It bulked up its business and it's done ever so well. The Novartis vaccines business, again, CSL had a vaccines business, bolted this on, got scale economies and did very well. And both of those businesses were bought from distressed trade sellers, but unfortunately its acquisition of Vifor was bought on the market at a 40% premium. In a business, in terms of renal disease and iron deficiency, that it had no experience in previously. And that's a burial ground for returns, unfortunately. They expended $12 billion US for the acquisition. They're only going to make NPAT to CSL shareholders of around 400 million. That's a 3.7% return on invested capital against CSL's traditional 20% plus return on invested capital. It's dragged the entire business down to a 10.5% return on invested capital, and the stock has spent the last 18 months derating. And from our calculations, it's probably costed $100 a share in its share price.
I think Peter Lynch called it diversification. It sounds a bit like that. Thanks for that. James, I think you're going to tell us about the banks, which you touched on earlier, but maybe just to fill it out a bit more about what's happening with the banks and certain banks in particular.
Yeah, I think, I touched on it earlier about the money that's flowing into chasing momentum with financials performance globally, which has extended into Australia and the Asia Pacific region. The banks, the big five, I'll call them, being the typical big four plus now, Macquarie, make up 25% of the index. So when people talk about the market in Australia and how the market's going to perform, they need to take a view on the banks because they're a quarter of the index. The passive flows I touched on earlier, the industry super funds are bringing more and more money in-house away from active fund managers and deploying that money into passive money. So when Australian super is a $300 billion fund under management business growing to $1 trillion in 5 years' time, there's a flow of funds that's really flowing into that part of the market. I think the challenge for the banks is when you take a step back and you be objective and you look at their valuations, you say, on what reasonable basis should CBA be double the valuation of JP Morgan, the best bank in the world? On what basis, when there's no EPS growth, should CBA's multiple be at 2-decade highs? It's really hard logically to look our clients in the eyes and say that's good buying at those values. So what will drive that re-rating down? I think it's when the CIOs in the industry super funds go, a quarter of our Australian equities exposure is, exposed to Australian banks, which are, in their view and most market pundits' views, significantly overvalued. If they decide to change that flow of funds, that's something that could, really, derate the banks. It wasn't that long ago, like I mentioned earlier, the CBA was at $90 a share, and now is reaching all-time highs above, $143, $144 a share. Like Macquarie, also reaching, all-time highs.
Very good. Now, Ben, always the opportunist.
Yes.
Bad is in your eyes bombed out market, but you've always had a bit of a liking for resources. Been bad the last year,
Yes.
When everyone was probably long a year ago. How do you see it playing out, and is there an opportunity out of the bad?
Well, I'm not about to rescue James on his resources call, but what I'm going to say is we're talking bad. We're talking energy and all its guises. The energy complex is bad. I'm not sure if we can't have missed it, in fact. Thermal coal prices this calendar year are down 20%. Oil prices down about a third. Uranium prices are down about 28% from their highs in February, as there's been a genuine outbreak of concern about global recession and demand impacts, and all forms of energy have come under heavy selling pressure. Most recently, the crude oil price, I saw a reference to the largest short position in 12 years is now in position in the oil market, in the crude oil market. So the positioning is very, very acute and basically assuming worst case outcomes. And as I mentioned, uranium as well. Uranium has fallen foul of all sorts of scaremongering, but also seems to be a beneficiary of all sorts of good news that hasn't been at all discounted. We had the Kazakhstans downgrade their earnings or their production expectations for 25. We've had a coup in Niger in Africa, which is about 4% of production. So we've seen some rather bullish triggers in the energy market or in the uranium market certainly, but there's been no follow through in stocks. So, and within that, I think where the market's losing it or forgetting it is medium to longer term. There's a neat integration between energy and AI. And I know there's been a lot said about AI today, but energy and AI are interlinked. Did any of you see the announcement earlier that Amazon had bought a 960 megawatt data center that's drawing its power directly from the Susquehanna nuclear plant? So already we're seeing AI connecting with renewables. And BP, just a couple of nights ago, announced it was doing a deal with Planeteer, the spyware software company, so that BP can start using AI to more profitably and accurately exploit geological interpretations. So I think the market's got far too carried away with how negative and bearish demand for energy will be, certainly in the short term. It's had a profound effect. It's been bad. All forms of listed energy stocks have been pummeled. And for us, there is, buried amongst the ruins, some longer term opportunities there.
We'll be listening for the bell when you ring it. We'll all hear it.
Yeah.
Dave, as I said, we're getting tight on time. Your bad EV world, but in particular Tesla, for the shorters of the world, that's been a widowmaker over the years. Can you give us just maybe 90 seconds, 2 minutes on where Tesla's at?
Yeah, no problem. So Tesla obviously featured prominently in past Livewire sessions. It's a name that for me, it's priced at a gross stock multiple, 110 PE, yet its margins are down from 17% to 7%. Its revenue growth is faltering. The earnings is in downright contraction, and their lineup is very, very, very tired. But that said, so it's a growth stock that's not growing, but I would never short Tesla. Tesla, there's a non-zero probability. Elon is a genius that, they will pull off autonomous driving. If they do, then Tesla's worth every cent. So, I think you're a brave investor to bet against that.
Great, good summary, thank you. Okay, let's get on to the ugly. We haven't got much time, so we'll make it short. Dushko, start back with you.
Yes.
Company that might look a bit ugly, but the market's kind of held it in good stead over time.
Yes, not all growth stocks are made equal. And whilst Seek was a pioneer along with Car Group and REA 20 years ago, it's been an absolute lost decade. So if you look at the EPS of Seek versus 10 years ago, its EPS next year will be 22% below what its earnings per share was 10 years ago. When you look at REA, its EPS is 3 times higher next year than it was 10 years ago. And when you look at Car Group, it's 2.5 times higher than what it was 10 years ago. So it's more than a lost decade. They've actually gone backwards. It's been a tale of misallocated capital. Unfortunately, our IPO'd IDP Education for $335 million. It's now, even with its current headwinds, worth $4.4 billion. So that was a complete destruction of $4 billion of value that they could have harvested or given to their shareholders. And they've also had a heap of misadventure in Asia. Seek Asia today has EBITDA of $52 million, and 10 years ago it was $49 million. So it's a complete misallocation of capital. And unfortunately for it as well, it actually doesn't have as high a cash EBIT margin as those other businesses. Because of the capex to sales ratio being significantly higher than REA and Car Group, the cash EBIT margin of Seek is only 28% versus 48 and 42 for the others. And when people have a look at the valuation on an EV to EBITDA basis, they're completely missing the capital expenditure. And whilst it looks cheaper on EV to EBITDA, the PE normalizes everything for your capital expenditure, your D&A. Unfortunately, it's actually on a higher PE at 50 times than both REA Group and car sales. And its earnings are going backwards 20% next year. It looks more like BlueScope and Sims in terms of its volatility of earnings, because it's got an NPAT range of 130 to 180 million 1 year ahead, than a true compounding growth stock such as the others I've mentioned.
Thank you. Ben, we're going to go to you. Even though you're small and mid caps,
Yeah.
Got an international view on what
Yes,
looks ugly?
I have. And I'm going to take the room behind the beaded curtain. It's China. It's the Chinese property market, which is ugly and getting uglier by the day. You saw 2 days ago, it was reported, Chinese house prices fell at the fastest pace in 9 years. There's been a complete give up by the look of things in the Chinese property market, with very little central government assistance or intention to start unveiling stimulus. It just hasn't been forthcoming. Well, we're subscribers to GavCal, which are a very handy Hong Kong-based economic consulting group, and they superimposed the GFC-style housing collapse we saw in the US, Ireland and Spain, and they superimposed it in terms of price and time. In price, they said the US and Spanish markets had property price corrections of about 35% by the time the cycle had wound its way out. In China, we've seen about an 8% fall so far in new dwellings and about 11% fall in existing dwellings. So interpolating or overlapping the trends we saw in other major crises, we're not halfway done, anywhere near that on price. And in terms of duration, the same housing crises we saw through Spain, Ireland and the US, from peak to trough, took about 10 years to wash out before properly recovered and the demand came back in. We are only 4 years into the Chinese property market debacle, which peaked in 2020. So we are nascent in terms of where this crisis is going, and we're certainly nascent in terms of the price. The reason I bring it up, of course, is the contagion effect that now has. James talked about BlueScope. Already, the collapse in Chinese housing and construction has had impacts on hot roll coil margins. It's seen steel mills dumping steel into international markets. It's seen stockpiles of iron ore build up at ports. There has been a contagion effect that has come out of this, and it looks like we're not through it, which is not helpful to James's call on the resources recovery.
Makes a market.
So sorry to hijack the resources call, but I think there'll be an opportunity, but it just doesn't feel like it's soon.
Okay, it sounds painful. Dave, office markets, COVID, still haven't fully recovered? Still looks a bit ugly to you?
Yeah, I think so. Like, one of our shorts for the last 3 years has been Lend-Lease. Lend-Lease, it's a company that the cumulative free cash flow since 2008, and that's a time when interest rates have been accommodating, property's been buoyant, is negative. Cumulative free cash flow is negative. Now you throw into the mix a situation where the CBD's a ghost town on Mondays and Fridays. Melbourne's even worse. I think the road ahead for Lend-Lease is going to continue to be really, really challenging. That's one of the key thematics, not just in Australia, but various other places around the world that we're definitely exploiting.
Very good. Okay, so we've got about 5 minutes left in the session. We can open up for questions. As you can see on the board there, most in the room would have asked some questions in earlier sessions. So, all right, there we go. We've already got them. First one is, given the initial valuations of Wisetech, how were you able to identify this as a buying opportunity for the portfolio? I think that's at you, Dushko.
Yeah, great question. So we actually missed it on the IPO because we were sort of reorganising our small cap coverage at the time, and it was a small cap when it listed. And myself and the tech analysts walked up the hill to the Citigroup conference at the end of the year, and we decided to just meet all the companies we hadn't looked at before. Met Richard White, and we were just sort of blown away. Walked back down the hill as fast as we possibly could, and tried to resist the temptation of putting a buyer order on straight away without doing the analysis. But we whipped up a model in a week. We were really disappointed that the stock was trading $5.80, $6. It IPO'd at $3.35, and we thought, have we missed it? But I can say buying it at $6 and holding it all the way to $130 today, despite that valuation, has been one of the best things we've done in the fund. And I just highlight the fact when companies are early in their growth life, they can carry 100 times PE for a long period of time. Have a look at Salesforce. It's on a lowish PE now, but for the best part of 10, 15 years, it was carrying 100 times PE just by virtue of how fast it was growing. And just remember, digital assets have fewer scale effects than physically produced goods.
Okay, thank you. Interested in thoughts on Min Resources? I think that goes to you, James, because we've talked about Min Resources as something you don't mind at this valuation. It's had a tough year.
Yeah, so L1 went substantial in mineral resources, a few trading days ago. There's been some positive news in the last week in terms of the last condition precedent for the 49% sale of the iron ore haulage road to Morgan Stanley Infrastructure Partners receiving FIRB approval. That was the last CP, so now that will close and result in 1.1 billion of proceeds, pre-tax to, Mineral Resources. It was also, you would have seen that Qatar is taking a supply out of the lithium market, which was announced last Wednesday, and all the lithium stocks had a big bounce off that. So when, lithium spodumene is at 750, USD a ton, there's not many players making much money. So we think, it's more likely to see more supply come out of the market. You've also seen the gas business, which, the market, few in the market ascribes full and fair value to. The company announced that it was looking to consider, value realisation opportunities for that. So when you look at Min, people think of it as a lithium company or an iron ore company, but the reality is, first and foremost, you've got the mining services division. Then you've got a iron ore division, which is going from being high cost, low volume to high volume, low cost, and a lithium division, and then the gas division. So it's far more diversified than say the pure play lithium peers that it's often compared to.
Okay, thank you. I think we've got time for one, maybe two more. Might go to the fourth one there. Dave talked about being long defence stocks. Can you name a few? I know you already have, but is there a lot of defence stocks globally? Is it a big sector?
Yeah, massive within the US and massive within Europe. So
Or are we talking 30, 40 decent stocks? Or?
Yeah, absolutely. So yeah, like I mentioned, three that we're long: Lockheed, Bear Systems, and Rolls-Royce before. Like Rolls-Royce, 25. But people think of it as, well, it's certainly not a car company; it's an aerospace company. 25% of their portfolio is defence. That's up 200% since we bought it. So those sorts of names give very good geographic distribution. So yes, some great opportunities out there that are higher growth but are quite defensive at the same time.
Okay, Ben, you always like to have the last word.
Well, not always.
I thought I thought we might get a bit philosophical with you because you've got about 40 seconds.
Right.
What's your worst investment mistake over the past 5 years? And what valuable lesson?
Talk about being put on the spot.
Yeah, but
However, I do have an answer.
there's a big portfolio of them.
Yeah, there is. There's a great list to talk to and to draw from. I think, and it's a great lesson for all in the auditorium. I think one of our greatest investment mistakes was probably going into COVID, fearing the worst from where this pandemic could go and the economic multiplier effects that might be forthcoming. Our mistake was going in very well cashed up. And so we sold our outperforming stocks. We sort of became defensive at our positioning, and we built cash reserves to the highest levels that we'd had in cash for probably almost 10 years. And we felt great for about 2 or 3 weeks until at the end of March, as you'll recall, or end of February, early March, the Western governments of the world and the central banks of the world linked arms, and we pumped liquidity into the system and we lowered rates, which ushered in one of the biggest and most voracious stock market rallies seen for a long time. And we were caught with too much cash. And we were able to get invested, getting ourselves back into more sensible investment ranges within about 4 weeks, 5 weeks of that low being seen. But the lesson's very clear. If you're a stock investor, you're investing in stocks. Be very careful if you're trying to make a call on a major market move. And we got the move right. We got the pandemic. We were positioned, but we just got caught out. But we got ourselves invested, and looking at the numbers, you wouldn't know it. But I can tell you, living those sort of 2 or 3 months when we had just too much cash was a bit of a mistake.
I think the moral of that story is if you feel great as a fund manager, you're not allowed to. Something.
Yeah, well,
you got to feel a bit sick the whole time, a bit gooey in the stomach.
Yeah.
Look, I want to thank all our panellists. Been fantastic. Round of applause. And thank you very much for all the questions. Thanks very much, gentlemen.